many amendments have been introduced recently in VAT, excise tax, tax procedure law, and even updates on tax portal itself. So today's session is focused on touching upon two key elements. The first one is amendments on UAE VAT law, which will be covered by Mr. Rishi Chawla. And second one is other updates in the overall tax regime, which would be covered by Mr. Piyush Papneja. Some brief information about Premier Paints. Premier Paint was established 10 years back in Dubai, and we have our office in Abu Dhabi as well. Internationally, we are present in Oman and Kuwait, and our services are divided into four key lines. The first one is audit, which includes external audit, internal audit, feasibility studies, liquidation audit, and fraud investigation. The second service is tax and compliance, which include tax agent services, tax consultant services such as VAT, excise, transfer pricing, and ESR. The third service which Premier Brands offer, that is accounting services, which includes outsource accounting and CFO services. The last service which we offer, that is risk advisory, which covers merger and acquisition, business valuation, policy manuals, business plans, and feasibility studies. Our motto is always doing the right thing, and our goal is to become an international brand. So this is one of the reasons that we are having the philosophy of always doing the right thing. So we thought that in this critical time, we should step in to help the business community and advise them that how the new changes will impact their business. So without taking too much of your valuable time, I would quickly introduce our two of our notable speakers. The first section will be taken up by Mr. Rishi Chawla, who is a chartered accountant and MBA with certifications in AI, machine learning, and forensic. His previous experience include working with Big Four firms and equity firms, and from last 10 years, he's partnered with Premier Prince. Followed by Mr. Piyush Papneja, who is our tax manager. He's also a chartered accountant with well over 7 years of experience in taxation. And myself, Moin Ibrahim, I am the Senior Manager Risk Advisory with Premier Paints, and I will be the moderator for today's session. And I will try to ensure that we have such a great and informative experience. So before I hand over the slide to Rishi, I just wanted to mention that if you have any question and any query, you can just do type in the chat box. And at the end of the session, we'll try to address as much questions as we can. So let's move on to Rishi and see that what he has in his tax treasury box. Over to Rishi.
Thank you, Moin. Thank you for the warm welcome you have given and for taking time out today. Appreciate that. Okay, hello everyone. This is Rishi Chawla here. I've been very kindly introduced by Moin. So I'll be taking a session on the amendments on the VAT law. So I'll share my slide very quickly. I think one thing which Moin missed to add is that if you have any queries and questions, please try to put it in the chat window. We'll try to handle towards end of the session. And if something gets missed, feel free to write to us and we'll try to cover that as we go along. Right. Okay, so basically I'll be covering the amendments to the UAE VAT law and other recent tax updates. Just wanted to mention that there has been a lot of updates. But many updates are more or less towards clarifying certain aspects in the law, which was a little ambiguous to read. Though tax authority have continuously sent a lot of clarification all the time, but I thought they felt that clarifying those in the law will make it easier. So a lot of things are of clarification nature, but there are certain important amendments as well. So our focus will be mostly on the amendment which are kind of changing a little bit on certain aspects. So the other changes, if you want to access it or want to see the exact comparison, I'd like to just very quickly show you. All right. Sorry, I was talking about certain the screen where we have posted this blog. Sorry, I forgot to share my screen. My colleague has just reminded me. Sorry for that. So this is basically a blog which we have posted on our website, which has comparison uh, between the previous law and the current law and our comments. So you can see the relevant articles. It's here, and then when the previous law, what it was saying, and what's the current law is saying, and what our comments. So to go into more detail, you may always refer to this later on. For the time being, I think some people are still admitting, right? So I'll be focusing mostly on the major ones, and for other aspects, you can always look at it later on, right? So this is just the agenda. So I think already Moin has discussed briefly on it, and so I'll just go into the real amendments. So UAE VAT law amendments. So these are the key highlights. These are basically the major areas where we have changes. So first one is the background and effective date. So the previous law was issued way back in 2017, which was effective from 1st January 2018. And the current law is issued in 2020 in September, but it will be effective from 1st January 2023. So important to know that when you're reading this law, it doesn't mean it has started already, or it was, it came into effect the moment it was issued. It's not like that. It's basically the day you have to follow these provisions will start from 1st of January 2023. Right. So there's a statute of limitation. Basically, this talks about the powers of FTA on doing VAT audits. There are a lot of amendments in that. We'll talk about it. Then time limits on the date of supply, issue of tax credit note and tax invoices. There are, I think, we already have certain time limits mentioned, but there were certain clauses where time limits were not mentioned. So those clauses have been amended to include the time limits. So there are changes in this. And documentation. So there is, I don't know if you have really had a time to look at what reverse charge mechanism means. So I'll just talk very briefly when we come to that point. But there are certain provisions which can impact on recovering of input VAT on imports from reverse charge mechanism point of view. I'll talk a little bit briefly on what reverse charge mechanism is for people who don't know when we come to that point. And then the other key amendments are on the registration and deregistration, domestic reverse charge. Domestic reverse charge, I'm sure this must be like a fresh word for many, though we have this domestic reverse charge in the VAT law, but it's very specific to certain industries. So there are certain changes. Domestic reverse charge is very prevalent in the Bahrain VAT law, but UAE law being, it's not a very common thing used across. That's why it's not a very common word, but there are certain changes on this. So we'll talk about it. And then there are some changes on the out of scope supply, then valuation of deemed supply between related parties. This is an interesting one. We'll see to that. And more or less, this is what I'm going to cover. And then after that, we will take over. All right. So first one is about the FTA audits. So in the previous law, there was nothing. This article was not there. However, FTA always had the option to do the audit for the last 5 years. So now they have inserted a new clause basically into the law wherein they have clarified in more detail and very specific. Let's look at it, what it means. So the current standing of the law, because this is going to apply for 1st January 2023, says that the FTA can audit your books of account in the last 5 years. Right, so 5 years when we count, it's like it started from 2018. So 18, 19, 20, 21, 22. So we are running the 5th year right now. All right. So when this law gets implemented, if FTA issues a notification for a tax audit, say they issue a notification within the 5th year, they have the right to audit that accounts in the next 4 years. So what it effectively means is this opens the window for FTA to audit a company within 9 years window. For example, so now this is the 5th year which is running. Now, if FTAs start issue notification on the tax audit, so there's a high possibility that companies can get notification for tax audit. It also means this gives FTA the right to audit those company in the next 4 years. So the 5-year window then get expanded to 9 years, right? So this is one change. Then the second change is if a taxable person files a voluntary disclosure in the 5th year. So why it is saying in the 5th year specifically, because once the 5-year window is elapsed, then the FTA is technically not required to go back and do the audit. So if you have done a voluntary disclosure, because FTA does not check each and every case because they have a lot of things to handle. So voluntary disclosure, once you have done it, and you have paid your liability or whatever the case is, this clause particularly opens the windows to audit them in 1 year. So like, for example, if today I do a voluntary disclosure, the FT has a right to audit me in the next 1 year. So this was not the clause available last time. So this can happen for companies. Specifically, this can be an impact in the 5th year. So 5th year, if somebody does a voluntary disclosure and has not received a notification from FTA for the tax audit, still it gives FTA 1 year of window to audit them. So this can 5 to 6 years, it can very easily go. So I think it makes a lot of sense, because when the voluntary disclosure is done, the FTA is not sitting at the other side just to do the audit. So I think it's quite reasonable to put this clause. Then the next one is about the tax evasion cases. So tax evasion cases can be, I'm sure you know, good possibilities that company who is supposed to register did not register, or they have collected VAT and not paid to the tax authorities, or claimed refund which were not right or illegal. Those are some of the examples of tax evasion, though there are in the tax procedure law. If you go through it, there are a lot of amendments in that. So you can look at that. So now in these cases, FTA has a right to audit for 15 years. So there's no 5-year window in that. So it stretches to 15 years, right? So the last point in this, currently the voluntary disclosure, there's no time limit mentioned anywhere. So voluntary disclosure, for example, what happens is people, when they review their accounts, they find an error which has higher impact on the VAT, they go and do a voluntary disclosure. So right now the law does not say by which period you need to do it. It's like an open-ended story. So with this clause, they can do voluntary disclosure within 5-year window. It cannot go more than that. So what, I'll talk about implication of this point particularly is that now you can see very clearly that FT has very easily can stretch the window of 5 year to 6 year to 9 years or even 15 years, right? Because tax evasion is 15 years. That could be for registrant and non-registrants as well. And not knowing the clauses, and in the tax evasion cases, one thing need to notice is that just saying that I was not aware is not good enough an answer. Not knowing the law is not a good answer, right? So anything which you could have done properly, if you know the law correctly, does not evade you from being considered as a tax evader, right? So what it means is that this 5th year specifically, it's very important for companies to do their VAT health check to see if there are some errors which were done and not been corrected. This is particularly important because law has continuously to change over this 5 years. I have seen every month, 2 months, there are notifications, and trust me, it's not like a notification is issued and it is hitting your email box. It doesn't work like that. So what happened is they issue it, they are expecting the taxpayers or the tax registrant to go and stay updated. So if you're not aware there are changes, it might put you into a tax evasion, possibly a category which you never wanted to. There was no intent behind it, but just not knowing this provision can be an issue. So doing a tax audit or a VAT audits become important considering this stretch of window which has been amended through this one. So I'd spend more time on this because I think this has a lot of impact, and we are on the 5th year, so it's important, right? I think some more people have joined. I'll just add them very quickly. Right. Now about recovery of input tax credit. So input tax credit, the previous clause very clearly says that if you have a tax invoice and you pay the consideration within the time limit mentioned in the law, you can recover the input, no problem. right? The new law has also added two more clauses. So what it is saying specifically about import of goods and services, that you need to maintain the import documents and receive and retain invoices. Now I'll talk a little bit about reverse charge mechanism. For those people, for those who do not know what RCM or reverse charge mechanism means, so I'll just simplify like this. I hope I clarify you. So, like for example, if a foreign supplier is supplying goods or services in UAE, right? So obviously the foreign supplier is not registered for tax in UAE, so they are not going to charge VAT. However, the local supplier, being a registrant, always charge VAT to us, right? So with this structure, it very clearly makes the local supplier uncompetitive because they are charging extra amount VAT. Obviously, some can claim, some cannot claim. So it's not a good, even it impacts the cash flow. So it's not a very competitive situation. To cover against that, this reverse charge mechanism practices put in place. What it means is when a foreign supplier sends you an invoice, you record that invoice in your books with VAT, saying that you are basically uh, recording the VAT on behalf of the foreign supplier, right? And since now this is the service you have received and you have got the VAT invoice for which you have accounted the VAT in your books, now you can claim input VAT against it. So what in nutshell it means is you don't pay any VAT in the whole transaction, but you record the output VAT and the input VAT. So it's kind of a wash off, right? Now, what this provision means is that to do a wash off, you first receive a supplier invoice, so you record the output VAT, which you have to anyway do it. If you have a foreign supplier invoice received, you have to account VAT on their behalf in your books. Now, to claim the input VAT, you need to have a proper invoice and you have to retain those invoices. So in cases like this, if you don't have a good proper invoice from your foreign supplier with details of your company and things like that mentioned, you ideally cannot claim input VAT. So what it means is you end up paying VAT on behalf of the foreign supplier. So this is an important factor. Normally, what like I personally have observed is whenever there were foreign suppliers giving any services, for example, any licenses or any kind of online services, we just paid the supplier, we got a receipt from them, and we claim it in our VAT return as output and input VAT through the RCM transaction, and we are good with it. So email notification, debit to the bank account, these are some of the mechanisms which is very commonly followed. But with this provision, you're actually doing it wrong. So it's a clerical mistake, you call it could very well be a tax evasion, because you are taking an input VAT for something you cannot ideally take because you don't have a proper invoice, which is requirement of the law, right? So this is an important one. So please be very careful then when you are getting supplier invoices from outside suppliers who are not VAT registered in UAE. Please ensure that they send you an invoice and you have properly accounted for in your books. If they don't give you a proper invoice, then better to pay VAT on their behalf through the output VAT. That's a safe side. This is how we look at it, because some cases we find that our clients where they do get the they do payment to the supplier, but they don't have proper invoices. We normally are not claiming input VAT on those cases, but we pay the output VAT because that's the right way of looking at it. So this is an important clause. Now the law, because that was the intention right from the beginning, and it's now clarified in the law, right? Next one. Okay. Date of supply in special cases. So there's no major change in this clause. Basically, they have just kind of clarified in, I don't know how many of you are aware of Article 26. There are two main articles, Article 25 and 26, which talks about date of supply. Article 26 specifically talks about supplies on a consecutive or an ongoing basis or periodic payment basis, which is like more like long-term contract where you do work in piecemeal, you send invoices in piecemeal, things of that nature. So what happened in these situations is the timing of tax invoice, the timing of delivery of goods, supply of services, things like that are not very structured. So payment terms can be different. So it's a little bit of a complex structure. In order to help the tax registrant to comply with the law as well as do not impact their business model, this law has been given, Article 26. So, but one of the condition in this particular article is that if you have provided goods or services, you have to invoice them within 1 year period. So basically, you have to pay the VAT either the date of supply in this case is either when the tax invoice is issued, payment due, or you receive the payment. These were the three conditions. Or if nothing happened in this one, so for example, if you say have a 20-year contract, so first 1 year is a preliminary period, you have done the supply, you have done certain supplies, but you have not invoiced for, let's say, next 2 years. So it does not allow you to not invoice them for next 2 years. So within 1 year, you have to account for the VAT. That's what it's trying to say. Okay. So let me just show you in this comparison which we have, Article 26. So you can see here, this clause was always there 1 year from the date of supply, but now they have put it as a separate line item. So like there is no ambiguity now. So the people who are using this clause must know that this is very relevant for their business. Okay. Next one, date of issuing a tax invoice. This is another important. We already have 14 days period that when you supply, when your date of supply has passed, you have to invoice within 14 days. That's Article 25. As I mentioned, there are two important articles, 25 and 26. So far, 25 article is talking about supply of services, supply of goods. Like for example, I've done an audit for a company. I have to send the invoice within 14 days once the supply is over. That's simple as that. So Article 25 is for normal one-to-one transaction. Like trading companies, you have sold the goods within 14 days, you have to invoice. That's what Article 25 is. Article 26 is consecutive supplies. I just explained in detail in the last one, where you have a 1 year window within which you have to, within which you can, plan your timing of invoicing. But after 1 year, you cannot do it. So the 14 days window was there only for Article 25 before. Article 26 was not covered. But what this change has brought is it has also covered Article 26. That's the change here. Secondly, it has added another clause which it's saying that executive regulations of the decree law shall determine the cases where this date of issue of tax invoice can be there. So there can be new or additional aspects which FTA can add to it as and when required. So that's another thing added. Now, another point I want to just mention very quickly here is it talks about the executive regulations of this decree law shall determine the cases. Now, what it also can be interpreted in a way is that there can be more amendments to follow in the executive regulations, because the room to add new things is given in the law now. So the executive regulations now has the power to add those new things. So the people who have like joining for the first time, there are two main things in the law. One is a VAT law and then the executive regulation. The main is the VAT law, and the details or the specifics are covered in the executive regulations of the decree law. So the VAT law is amended. It gives more powers to the FTA to do changes in the executive regulation. So the executive regulation can or may follow. I don't know. So just wanted to mention that. Right. Mechanism of output tax adjustment, tax credit note. So tax credit note is another very interesting area which has been used quite widely across different industries in UAE. I have seen it personally, not in UAE, across GCC, different countries where we work, we have seen this. So in UAE, I'll talk very specifically to UAE. In UAE, the tax credit note can be issued, for example, if the supply you have done where the output VAT you were supposed to pay is showing more on your tax invoice than it should ideally be paid, then you should issue a tax invoice and reduce your supply. Basically, that's what you're trying to achieve. Now, the revised clause has put a time frame to it, that it's not like an open window that you can do in 6 months, 8 months time, not like this. If there is a change, you have to do that within 14 days. So let's read what the clause is saying. If the output tax calculated by registration exceed the output tax, it should pay. The registrant shall issue a credit note according to the provision of this particular law. To this line is added, registration shall issue tax credit note within 14 days from the date when the condition of issuing tax credit note occurs, right? So what is the impact of this? We have seen many cases that, things change, and, after 2 months, people go and change and do a credit note. Sometimes it could be that the real supply has happened or the changes has happened, but since the payment is not done, nobody takes care. Okay, what is the time? They're still following for the old invoice and without issuing the credit note, unless the time comes, the negotiation happens in such a way that you end up giving tax credit note. Now it doesn't work like that. So basically, once there is a change in the supply, and if you have to issue a tax credit note, you have to issue within 14 days. So how the tax authority know? I hope you have read the law, which says that when you issue a tax credit note, one of the conditions or the requirements of the tax credit note is that you have to always link the invoice for which that tax credit note is related to, right? So what it means is, so within 14 days, you have to issue the tax credit note. And the tax credit note, in the requirements, it also mentioned you have to mention the reasons and things like that. Just very quickly, I want to mention, if people ask you to, like, for example, you have sent an invoice to a client, and after 3 months, they have decided to pay you, and they say, can you change the tax invoice? And then you issue a tax credit note to issue a new tax invoice. If you do that way, that's actually not allowed. So 14-day window is important. Anyway, that is not allowed. There has to be a proper reason. The requirements of the tax credit note is very clearly mentioned in the VAT law and regulations. So please have a look at it. But just wanted to emphasize that 14-day window, which is for tax invoices, also been added for tax credit notes. Right. So now this one is about the related parties, specifically value of supply and deemed supply for related parties. Now, the value of supply for related party, the law, I think, even now mentioned that you have to have it at near market prices, or it has to be at market prices when you do a supply of goods or services. However, there is no mention on the deemed supply specifically. So deemed supply, for those who are joining for the first time, deemed supply, there is certain limit beyond which, if you give free of cost goods or services to your customers or anybody, you have to account for the VAT in your books or pay the VAT. So there is a limit defined in the law. I'll not go into that right now. So what I'm trying to say here is, for related party, the market price element is already mentioned in the law. However, for deemed supply for related parties or by related parties, there is no mention specifically for related party on this aspect. So if there is a deemed supply to related parties, you actually go to deemed supply provision under Article 37, which is at cost price. So for deemed supply, you can still follow cost price if you go by the law as it stands today. But with Article 36 and 30, which override 37, now even for deemed supplies, you have to go to the market value. This is what the change is. So summary: for supply to related parties, if it is a deemed supply, you could have done it at cost price as the law stands now, but with the amendments, you have to follow market price. That's it. Right. Exception from registration. This is another, I think, interesting and very helpful for the tax registrations. Not a big major change, but what it says is, like, currently the law allows companies which are only doing zero-rated supplies to basically apply for exception from registration. So if a company is doing 100% of zero-rated supply, there is no taxable supply, they can apply for exception from registration. There's a process of doing it, and you don't have to then comply with the VAT requirements and stuff like that. Okay, but that was so far it was only at the time of first time registration. So normally you apply it, for example, if you want to get out of it, you have to deregister. That's still a possibility is there. But in the revised law, it is allowing you to apply for exception even when you're registered and you're doing 100% zero date supply and you want to do it. It's not a mandatory requirement. It's an option been given wherein even an existing registrant doing 100% zero date supply can apply for exception. That's all. Tax deregistration cases. So this is also, there is a small clarification. This currently, of course, any company who is not like very briefly mentioned, if they're not meeting the thresholds in the last 12 months, they have to apply for the VAT deregistration. That's one line statement to say what a deregistration is. But with the current deregistration, it is actually two new things been added here. One is that if the FTA feels that a company has to be deregistered because to maintain the integrity of the tax system or whatever could be, I don't know what that means in specifics, but if the tax authority feels that a company needs to be tax deregistered, they have the right now to deregister any company, right? That's number one. Secondly is, once the company is tax registered, tax deregistered, it's like free world, like for example, the moment you got tax deregistered, okay, fine, now I am happy to go, and if there were mistakes, authority has not caught me, I am free bird now, so don't worry, be happy, that situation. But with this clause, what it means is that even if a company is deregistered, FTA still has the right to claim any tax or penalty even after deregistration. So if, for example, what it means is, right now, I'm sure you might have noted that the deregistration is one of the hectic processes in the VAT. It takes a lot of time, a lot of question answers from FTA. Basically, it's nothing that FTA is doing an audit to understand whether a company has to be deregistered. Now, this clause has another reason, could be that the FTA wanted to kind of fast track the process, but which also mean if they fast track it, they will not have enough time to audit the companies. So with this clause, it gives the power to FTA to go back to do a detailed audit at the later stage as well. So please keep in mind, even if you're deregistered, don't throw your books, don't burn your what you call stationery printed for the previous VAT period. You still have to keep it, because a tax audit, FTA still has the authority to claim any tax or penalty even after deregistration. I think some new people are joining. Let me see. Right. Okay. So this is, I think, it applies only to government entities and charities. Basically, I'll not spend more time on this. In the previous law, it says that input tax incurred by government entities and charities could be recovered as per cabinet decision. That was a simple term. Now they have clarified a little bit more that government entities which are engaging in sovereign activities can only recover input VAT, and charitable organization can recover input VAT when they're providing relevant charitable activity. So relevant charitable activity is actually discussed in detail in the tax laws. So what it means, so it's not like you input VAT in one and you can go and claim in one. You have to really follow a matching concept. So that's all for this one, because I don't think many of us are in this. Supply in special cases. So in the previous law, there's just one small line added to. There's no much change. So there's this, in the previous, out of scope included sale of issuing a voucher. So basically, utilization of voucher has a different provisions in the law than sale or issuance of a voucher. So issuance of voucher, there is no VAT at that stage, so it is out of scope. And similarly, if a company is sold as a going concern and the other part, it's a tax registration, then also there are certain conditions to keep it out of scope. In the revised law, both conditions are there. They have just added one more line, any other supply specified in executive regulation. So there is a very high level of a chance that there can be new areas gets added through the executive regulation, which also means the executive regulation may get amended at some point. We don't know when. So that's all in this. Reverse charge mechanism. So domestic, this is also not people who are dealing in hydrocarbons. It's relevant for them. So domestic reverse charge is similar to your foreign supplier you consider as domestic supplier. That's a reverse charge. So domestic reverse charge is also one of the conditions mentioned in the law. In this, basically, previously it was mentioned any hydrocarbons. Now, in the current one, they have clarified as pure hydrocarbon. That's the only change. The law stands same as before. So if you are dealing in hydrocarbons, look at the definition of what a pure hydrocarbon is and see if your company falls into it, and then accordingly you can imply the conditions mentioned in the domestic reverse charge. Next slide. Place of supply of goods. This is an interesting one. Basically, this again article talk about a little bit on the Article 26. So I've already explained what Article 26 is. It is about continuous supply. Let me just see my time. So I have to quickly wrap it up. So Article 26 talks about continuous supply. So this particular condition says is that in case if you are into a continuous supply of goods or services, and in this process the goods have moved out of UAE, so there is a supply of goods involving export or import, basically goods moving inter country, it has moved out of UAE to another place or have come in. So in this process, if the ownership of goods happened in UAE, then there can be UAE VAT implication. So what it can mean, just my thoughts on this is, for example, if you are in a continuous supply and say, for example, you are doing an event in another country, and the ownership of goods have changed. In event, the default rule applies where the event takes place, right? Place of supply. So if the ownership of that goods has happened in UAE when you are exporting those goods, or it's in a continuous supply, so there are certain impact on companies who are into import and export, and secondly, who apply Article 26 on continuous supply. So this article is important for companies who are in export or import. So their business involve exporting or importing goods, and secondly, they apply Article 26, which is a continuous supply. For rest of people, don't worry. But for these two people, read this in more detail. I think we can spend more time on this, but I don't have that time right now. So please touch base with us in one-to-one if you want to discuss further. Thank you. Okay, this is last page of my session. So there are certain definitions which are changed. You can go through our blog to look at various aspects like tax evasion, tax audit, but not defined. Now it's defined. Article 25 has certain amendments have covered new categories as mentioned here: rescue plane, ships, means of transportation, goods related to means of transportation, and things like that. Then Article 65(4) has been amended. That is, it is mandatory for person to pay the VAT. So this is a good one actually. The previous article also mentioned that if a company or a person has charged VAT, they have to pay the VAT to FTA. It was there. But now they have stressed it and amended to just added one more word. It's mandatory to pay the VAT if they have collected. So where it can apply, let's think about this. So for example, if there is a company who is doing zero rated supply, it has happened a lot of cases where companies are only doing zero rated supplies and they have collected VAT from the tax registrations. Tomorrow, a tax consultant comes and do the review and tells them technically they are not allowed to do it, charge the VAT on that. So what it means is that now you have the VAT. Either option is you refund it to the people concerned or you pay to FTA, right? So now this is like a mandatory condition that if you have collected the VAT from the tax registration registrants and you're not supposed to have done it, or for example if you're not VAT, many confusion people have is the moment they apply for VAT registration they start charging VAT. It's not like that. Till you have the VAT registration number you cannot charge VAT, because that's the time the FTA will give you the VAT period for which you have to file the returns and pay the VATs. But in the meantime, if you have collected VAT from any tax from any people, then you are supposed to pay to FTA, and it is mandatory. That's what it means. Clause 30, I'll not go in detail. It mentioned basically transport services, but they have just added one more word to it, transport related services. So people involved in this business can go through it. So I think with that, I'll end my session and I like to hand it over to Piyush to take it over from here. Piyush, are you there? Please, can you start the session? Sorry, I think he's not able to access this. Let me just give me a moment, please. Piyush, now you can unmute yourself and talk. Sorry, I have not given you that access.
Good afternoon, everyone. Thank you, Rishi, for giving us a valuable insight on the recent VAT amendments. Now we are going to cover some other changes that authority is going to implement in UAE. So we'll be covering 4 more points. EMARA Tax is a new website which FT is going to launch. There will be a new, there is a new cabinet decision on tax residency, and there are some amendments in tax procedure and excise tax law. Can we go move to next slide, please? Yeah, there are some key highlights of EMARA Tax. EMARA Tax is going to be a new integrated platform to digitalize the tax administration in line with the UAE National Digitalized Agenda. It's going to be an integrated platform that will be integrated with the other government entities such as central bank and national technology based programs, UAE PASS, that will use the common data to provide the simplify the tax procedures. EMARA Tax is going to give us the option to have a offline VAT return, and then we can review and declare it. There will be a new VAT refund application, and then there will be a, for the payment of VAT and penalties, there will be a reference number based. It's not going to be a direct payment now. And they are going to be adding some new tabs also in the new website. So the first tab which they are going to add is required action. Required action will have all the upcoming due dates for the payment and for all the returns which we are supposed to submit. Then there will be a tab for most used services. Most used services will show the recent services or a public clarification or any other law we have used and or any other service or tab we have used. And then we'll be having a my correspondence. My correspondence will be having all the emails or notifications which FT is going to send to all the taxable persons. And there will be not like we won't be having any kind of a reply which we are going to make for those emails, but all the communication from the FTA to taxable person will be in the my correspondence. Then there will be a separate tab for my audit.
My audit will include all the communication, notification, and assessments, or any notice for appeal or anything which from the FTA to taxable person will come in the my audit. Complaint history will have all the reconsideration, all the penalty waiver applications, or any technical glitch and points which we are sending emails to FTA. We'll have the history of all the complaints in there, or if any kind of a call we are doing to FTA, that will be shown in the complaint history. Can we move to next slide, please? Here we are mentioning some major changes which will be introduced by EMARA Tax. First change will be there in the applications which we are submitting to FTA. That is like all the applications, registration, deregistration, amendment application which we submit to FTA. That will be there. There are some changes which FTA introduced through EMARA Tax. All the bank details, IBAN number, Emirates ID, or any other local documents will be real-time basis will be validated. There are some new features which FTA is going to add related to the all the registration and deregistration applications. First one is convert to TRN, then TIN-VG and VAT re-registration and reactivation. Convert to TRN will be helpful for all the clients who have applied for the exception for registration and then started making a standard rated supply. Now there won't be a need of any separate or a new registration application. They can directly convert to TRN. So there won't be a need of any separate application. All the procedures, all the documents is already there, and we don't have to apply for it. And then there will be a tab for the TIN-VG. TIN-VG is for all the group companies. If any member, we don't want to be in a group, but is accidentally considered in the tax group. With this, we don't have to apply for a deregistration or amendment in the tax group and then re-register the company. With a single application, we'll be able to take the company out and register it. Then VAT re-registration or reactivation is applicable for all the companies who deregistered themselves because they were not having any taxable supply in 12 months period, and then they were supposed to deregister. After sometimes if they are started having a taxable supplies, they don't have to apply for VAT registration. They can simply reactivate their OTRN. Now, there are some changes they have made in the VAT return. As I mentioned previously also, VAT returns template, we can now download and upload the same. It will automatically fill all the details. So it will give us chance not to make any clerical errors. Now, another change what they have made is tax refund details, tourist refund. Now we can check in details against which all invoices that tourist refund is related to. That same amount we can match with the Planet tax invoice. Now, after submitting or uploading all the details, there will be a separate page for review and declaration. That type will be appear before the submission of the return. So in that case, we can re-review our return and then before the submission. Now there are some changes they have made in VAT refund application. Now in draft refund application, IBAN can be added at the time of refund application itself. If there is a change in the bank details which was given at the time of registration, that can be added at the time of VAT refund. And now the VAT refund can be applied for the extra or any advance payment made, or if there is any payment or like we have shifted from a tax group to a tax single tax registration. In that case, if some amount is left over there, we can apply for that refund also. And now the FTA will be giving through EMARA Tax, there will be a separate tab for each the refunds. We can apply for on a proportional basis also. And we can upload all the transaction wise details return wise. We don't have before earlier it was a single tab where we have to submit all the details for all the return in one place. Now we can upload the details based on the returns. There are some changes they have made for the VAT and penalty payments. Now it will be, first of all, it will be based on the reference number. For all the transactions, we can select separately for which all return or payment we want to make a payment. That will generate a reference number. That reference number can be given to the exchange house and banks to make the payment. And then it needs to be exactly the same. If the reference number is changed with a single digit also, it will not reflect the payment on FTA portal. Now we can make the payment for the upcoming return in advance. Now, if we for in the current portal, if we are making the payment, it is getting adjusted if there is any payable amount is there. With the new procedure, you can specifically select a upcoming return and make the payment. Same will not be adjusted with the amount payable by any taxable person. Can we go to the next slide, please? Now we are going to cover a tax residency. There is a new cabinet decision is issued. Cabinet decision 85 issued on September 2022 will be effective from March 2023. That will give us the determination of tax residency for legal person and natural person. For a legal person to be a tax resident in UAE, they need to be incorporated, formed or recognized in accordance with the law and regulation enforced in UAE. That will not include the branch of a foreign company, and they are considered as tax resident in the as per the applicable law. For a natural person to be a resident, they have to be they need to have a place of resident or a business in UAE, or they are physically presented in UAE for more than 183 days in last 12 months. And then there is a third option, which is a combination of both the two above options. That is, if they are physically presented in UAE for more than 90 days and they are a UAE or GCC national or a resident visa holder, and they have a permanent UAE resident and working place in UAE. And now the point we have to notice here is, like, if there is any international agreement such as double tax treaty, so and they have laid down any residency rules that will prevail over the tax residency rule cabinet decision 85. Can we move to next slide, please? Yeah, now we'll be covering the new tax procedure law. FTA have issued a Federal Decree Law 28, which will be revoking the Federal Decree Law number 7. It is issued on 30th of September 2022, will be affecting from 1st March 2023. Basically, what they have done is, like, what all the changes they have done in VAT law and excise law, related amendments are done in the tax procedure law also. They have added the definition, they have and amended some existing definitions. For that, you can refer our blog also. We have given the detailed explanation on the definitions. And then the major change which they have made is on the voluntary disclosure. Before the voluntary disclosure, we used to submit only when there was a impact of tax payable amount more than 10,000. Now it is compulsory to submit a voluntary disclosure for any clerical error or any omission which is not resulting in a tax due. So, like, if we are mentioned supplies in Dubai and was supposed to be mentioned, and we have selected mentioned it in Sharjah, that needs to be corrected by submitting the voluntary disclosure. Now, Article 46 is amended to mention the statute of limitation, as Rishi explained it to us in detail. It's the same. All the related amendments are done in tax procedure law. I'm not going into the detail as we have already discussed it. Now they have changed the business days from 5 working business day to 10 business days for all the tax audit and all the notice or notification for the tax assessment. They have added one more law article which giving the Director General a right to ask the court to issue a order for seize of property for any tax due, and they believe that it might lose. That authority might lose. For that, they can ask court to give a seize order for the properties. Any person, now for all the assessments, now before the reconsideration letter, any person can ask FTA or other authorities for the review of their tax assessment within 14 days. But the condition is there should be no reconsideration letter for that assessment. Can we move to the next slide, please? There are some recent amendments in excise tax law also. So public clarification also issued on the same, like explaining all the amendments are done in the excise tax law. So basically the same, they have added the tax assessment, tax procedure law as what all the changes are done in the tax procedure law will affect all the articles. They have added it here. So Article 5, 20, 22, 23 are amended to add those definitions. The major changes in the excise tax law they have mentioned is like person importing the excise goods for the purpose other than the conducting business will not be required to register for the excise tax. However, they have to pay any excise tax or an import or any other administrative penalties if any is there. As Rishi mentioned, like if anyone is collecting VAT, before it was not specifically mentioned to pay to the authority. Now they have added for the excise also that if anyone have collected excise, they were not supposed to. The same is added here that they have to pay to the authorities. And then another the same amendment they have done in excise law for the statute of limitation that Rishi discussed in the detail. Like this, all the changes is exactly the same. They have added in excise law also. Can we move to the next slide? This was from my side, sir, everyone, and we can open for a Q&A section. If anyone have any doubt, we can reply.
Thank you, Piyush, for the interesting session. It was good to meet. I think this was mostly in briefing about the law, so I think there are not many questions because it's more of informing about the changes that has happened. And with that, unless if there are any questions, we can take up. I think there are questions. So first one is from Lindy. She says, would the VAT, I think I will add Bhavna also on the call. Bhavna, I'll just add you. So if you can always add any points you want to mention. 1 second. Bhavna, now you can unmute and join if you like to.
Yeah, hi everyone. Hope you can hear me.
Yes, loud and clear. Okay, so we'll just take up the questions and end the session after that. So we are just 1 minute ahead. So please give us another 5 minutes to finish this off. So Lindy says that would the VAT Y RCM be applicable on transfer pricing adjustments?
Okay, so I'll take that. So basically, I understand that there could be transfer pricing adjustments where you are, increasing or decreasing the value of the supply for the goods and services between the multinational enterprises. So ideally, like until now, there is no corporate tax in UAE, but it is going to be implemented very soon from June 23. So transfer pricing will very much become important to be analyzed. But going as per the the intention that if the value of the goods and services are getting increased and you are changing your financials with that increase, ideally the RCM should also be applicable, though currently there is no specific provision on this in the VAT law. But we expect, as the corporate tax law gets implemented, such kind of clarifications would also come in respect to the VAT on such kind of transfer pricing adjustments.
Right. Okay. So there's another from, I don't know the name, but it says info. So Mr. Info, if you're there, sorry, I don't know, I can't see your name. That's why I just have to just say that way. So he asked a very specific question, which says Article 27.3, will it apply to cross-border transactions as well?
Yeah, so basically, so basically the change in the Article 27.3 is related to continuous supplies with respect to import and export. So yes, it applies to the cross border transactions because it is related to import and export. But main thing is that it has to be continuous supply. not a one-off, supply of goods. So very specific. It is about continuous supplies.
And one question is again said is where customers in UAE, what will be the VAT implication? I think it's continuation to that one.
Yeah, so like Rishi mentioned earlier, that if the ownership of the goods is transferred in UAE and it is related to a continuous supply, then the place of supply will be considered as UAE.
Right. And I think last he's trying to say is that, for example, goods are cleared by customer in UAE, shipment is from India, and ownership is with UAE company and payment received in US. So again, this point, as Bhavna said, if the ownership transfer is done in UAE, the place of supply could be UAE. So, but we have to go in more detail before to answer it correctly.
Yeah, but the thing, the person has not mentioned whether it is a continuous supply or not, because that is the important change amendment. So better we can take their specific case and answer accordingly. So they can get in touch with us through email.
Okay, so now Pranav has two questions. So first question he's asking is, with the new amendments, what is the period to retain records? It's a interesting one. So I think retaining record should look at 9-year window, in my opinion. But at least 5 year, definitely you have to look. So basically, in the 5th year, if you have not done any voluntary disclosure, nor you have received any notification from FTA for tax audit, you have to keep 5 years. But in the 5th year, if you don't get both of these two, then you are free to basically, uh, you know, trash the item. But I think better not trash it. Reach it, stretch it to 9 years period. In my view, I mean, again, it's upon your case, because, for example, if FTA has issued you a notification, it might have been sitting in your email or your spam folder or whatever. You have to be careful that the notification or the official channels which are operating with FTA is accessible at all times with you. So any email or any notification sent from their side, if it gets missed, you cannot fight the case saying that I didn't see it. So that's my view. Then next question which he says is, any specific limit is there for showing RCM in the VAT return?
Yes, basically, the same rules apply for RCM also. So you are reporting basically the liability on behalf of the foreign supplier, but the date of supply rules still remain the same for the RCM output.
Right. Yeah, output the same, I think rules apply in this case. The next question is asking, if an invoice is not raised within 14 days, how do we correct this? Is voluntary disclosure required if more than 10,000? I think, how do we correct this? So basically you have done the supply, you have not corrected this. If it is less than 10,000, obviously you can, I think, go and do the correction. But if the value is more than 10,000, that's the VAT amount. If the value is more than 10,000, then the only way I think is voluntary disclosure in that case. I mean, to do it correctly.
But the question here is that he's talking only about the invoice not raising, because the date of supply, if it was already triggered before, then anyway they should have reported in the VAT return. So that would mean correction of the return if the date of supply was also missed, because this is about raising the invoice within 14 days. But the date of supply has to be kept into note for reporting in the VAT return.
Right. So Pranav want to also discuss this point. So I think let's add him and hear it from him. It's always good to hear good questions and try to take it up. So Pranav,
for not raising the invoice in time, there is penalty. For each instance, there is 2,500 that we need to pay. For all, like when we don't raise the invoice on time and then we are not following the law. So the basic minimum penalties are there, and then the like for the each instance. So if you are not raising the invoice in time, there are penalties, and if you are missed out to properly mention in the return and impacting more than 10,000, then we have to go for the voluntary disclosure also. But for the invoice not raised in the time, we don't need voluntary disclosure as such, but there are penalties other than that.
Right. Pranav, I have unmuted you if you want to ask the question. Otherwise, if you're happy with this, it's fine. So he's asking if tax credit note issue within 14 days from invoice date or from goods return date.
It's from goods return date.
Goods return date, yes. All right, I think there we have no more questions and we are already 10 minutes above the time. So thank you very much for joining. And if you have any further questions, please feel free to reach to us. We'll share the presentation later on and also the recording for you to access it later on. And have a brilliant day and a nice weekend. Thank you very much. Bye-bye.